DSCR loan rates and conventional mortgage rates both climbed this week. The 30-year fixed rose 13 basis points from 6.52% to 6.65%. And DSCR loan rates followed right along, landing around 7.4%. Here's the strange part. Bond yields actually eased at the same time mortgage rates went up. Stay until the end. I am going to show you exactly how staying under key loan-to-value thresholds can help you protect your DSCR loan rate from adjustments most investors never see coming, even while the broader market keeps grinding higher.
The plateau nobody wanted. Why 6.68% isn't going away.
Mortgage rates touched their second highest level in more than 10 months this week, with the top tier 30-year fix briefly hitting 6.68% before settling back down. That is not a blip. It is confirmation that the sharp rate drop investors saw late last year have stalled out completely. Lenders are still pricing in stubborn inflation, which means the easy relief everyone was hoping for this summer just isn't showing up. For anyone waiting on the sidelines for rates to fall back into the fives, this week was a reality check.
The disconnect. Why bond yields dropped, but your rate didn't.
The 10-year Treasury, you'll think of it as the government-owned borrowing cost, actually ticked down slightly this week, easing to 4.53%. Normally, when that number falls, mortgage rates follow close behind. Not this time. Lenders kept a wider than usual gap between what the bond market was doing and what they are actually charging borrowers. So the relief investors expected from lower yields never made it to their loan quote.
The rate update. The major economic indicators and how they're affecting your wallet.
Initial jobless claim. The number of people filing for unemployment benefits each week stayed close to normal. Healthy levels again this week. That is good news if you care about job security and rent stability. But it is not great news if you are hoping for a rate cut. A strong job market gives the Fed less reason to lower rates anytime soon. And speaking of the Fed, their latest meeting notes echoed that same message. Policymakers aren't in a rush to cut, pointing to inflation that is still running a little hotter than they will like. Translation, the higher for longer approach isn't ending soon, so don't count on Washington to bail out your borrowing costs anytime in the near term.
Your move? Lock now or hold out for a drop that might not come.
Multiple rate providers are now confirming the same story. Bankrate, Money.com, and MND all show the 30-year fix settling firmly in the mid to high 6%. That kind of agreement across sources tells you this isn't a fluke. It is the new normal from now. If you have got a deal that works at today's numbers, locking in removes the guesswork. Waiting on a rate drop that multiple data sources say isn't coming yet is a bigger risk than most investors realize. Now, let me unpack the strategy I promised. Staying under key loan-to-value thresholds. A lot of investors don't realize that crossing certain loan-to-value lines, like going from 70 to 76%, can trigger a real pricing adjustment on a DSCR loan, sometimes pushing your rate up by a quarter point or more. If you can structure your deal to land just under one of those thresholds, even by putting a little bit more down, you could be looking at meaningful, better pricing on the exact same property. I'm Eli, the DSCR Pro, and if you have got a rental property deal you're looking at, or you just want to know if there is a way to lower your monthly payment, I want to hear about it. Sometimes a short conversation is all it takes to find a strategy that saves you real money every month. Our contact info is in the description below. Reach out anytime. Hit subscribe so you don't miss the next week update, and we will see you there.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.